With all the recent headlines about trade tensions and market volatility, we know many of you are concerned about your retirement accounts and investment portfolios. While the uncertainty can feel unsettling, our role is to help you understand what's happening and to put these developments in perspective. I'm Vanessa Welch, VP of Financial Insights at Empower, and I'm joined by our Chief Investment Strategist, Marta Norton. Marta, let's start with the basics. What exactly are tariffs and how do they affect our economy?
Tariffs are essentially taxes paid by foreign producers when they sell their goods to domestic consumers. They're actually used by a variety of countries around the world. In the case of the US, tariffs have actually featured pretty predominantly in US economic policy, though in recent decades they've fallen off precipitously as the US has taken more of a free trade approach, meaning it has had limited tariffs on foreign producers. That changed during the first Trump administration when the Trump administration used tariffs to correct trade imbalances or instances in which America was buying far more than it was selling to other countries.
That's helpful context, especially to hear how tariffs have evolved over time. What's driving this policy approach toward our largest trading partners?
On the campaign trail, and since then, Trump has talked about tariffs in a few ways. One is a way to raise revenue for the federal government. Another is to correct trade imbalances, as during the first administration. And a third is as a negotiating tool, even in areas unrelated to trade. We can think of tariffs really as an extension of Trump's America First agenda.
I think the diplomatic breakthrough with Mexico and China was particularly interesting. Do you see these tariffs primarily as negotiating tools rather than long term policy?
I think in the instance of the developments over the weekend and during this week, we can look at these tariffs as negotiating tools. In the case of both Mexico and Canada, Trump cited border security. He cited the movement of fentanyl across the border as two critical concerns. And when Mexico and Canada addressed those two concerns, he delayed the tariffs. But I think it's very important for investors and folks at large to remember that tariffs are not necessarily only a negotiating tool. The very fact that Trump has talked about them as a revenue generation tool would suggest that he's at least considering tariffs as broad-based and long-lasting.
So let's focus on China, where the 10% tariffs just went into effect today. The US tariffs cover all goods sold by China to the United States. So where can we expect to feel the biggest impact?
Well, remember that the US has had tariffs against China since the Trump administration, and many of those tariffs carried forward by the Biden administration. The real difference that you're calling out is the fact that these tariffs are broad-based. So certain goods that weren't covered by the tariffs that we've seen over the past several years are covered with this new set of tariffs. That includes a lot of consumer electronics, so anything from cell phones to tablets, TVs, laptops, and it also includes a range of other industries. Footwear is one that might catch folks off guard. A lot of sneakers sold in the US are actually made in Vietnam and China, so that's another industry to watch for potentially higher prices.
I hadn't even considered the footwear industry, Marta. I think that's going to be surprising for a lot of people. We know that China announced retaliatory measures against US tariffs yesterday. What does this escalation mean for our markets, and how concerned should investors be about this tit for tat response?
Well, interestingly enough, the Chinese tariffs are a little bit more surgical and less severe than the tariffs that the US has levied against China. There's a range of different reasons for that. A few things to call out. China exports way more than it imports. So Chinese tariffs just don't bite as hard to begin with. But secondly, the Chinese economy is in a weaker point than the US economy. So there's just not as much bargaining power. There's a few things to call out from a bigger picture perspective, though. The very idea of tariffs and levying tariffs against other countries can mean retaliation. And Trump is taking on a number of different countries at the same time, which means that this retaliation can come from a number of different angles all at once. And there's no question that from at least an economic perspective, tariffs can hurt an economy. They can squeeze earnings as companies face higher input prices or mean a little bit more inflationary pressure. as companies pass along those prices to consumers. I would add, though, that the U.S. is on better footing to handle some of this climate. Consider the fact that when we're looking at trade to GDP, and I'm gathering these numbers from the World Bank, we see that those numbers from 2023 were about 25% for the U.S. Compare that to 37% for China, or 67% for Canada, 73% for Mexico. In many ways, the U.S. economy is diverse enough and at a strong enough point where potentially tariffs wouldn't be as devastating here as they would be abroad.
Really interesting perspective, Marta. We know economists are predicting potential economic impacts through 2026. What's your guidance for people who might be tempted to make portfolio changes right now?
Well, my biggest concern when it comes to investors who are saving for long-term financial goals is overreaction. There's not a straight line from media headlines to market behavior, particularly market behavior over the long term. So if an investor is attempting to adjust his or her portfolio simply based on these headlines, they might make some really poor decisions. There is one caveat that I'd like to add. We've been in an incredibly strong equity market. We've had 2 years of 20% plus gains, and valuations, or the prices we're paying for the stocks that we're buying, they're quite high today. That leaves us more vulnerable to a sell-off. And so we're suggesting that it's an important time for investors to lower their expectations for the U.S. equity market. And having those lower expectations can help investors stay the course come whatever may over 2025.
Marta, thank you so much. That was really comprehensive. And for everyone watching, remember, your financial journey is a marathon, not a sprint. While market headlines may seem concerning, staying focused on your long-term goals is key. If you haven't done so recently, now may be a good time to connect with your advisor to navigate these developments with confidence. Thanks so much for joining us, and we'll see you again soon.